Welcome back, you guys. Today I'm going to show you guys how to trade more like me, and I'm going to show you how I use Equilibrium and how I've been using it. So first of all, let's figure out what Equilibrium even is. When we go to our Equilibrium, I preferably use the Gone box. I know a lot of people like to use different things like the fib retracement. It's basically all the same thing. As long as you can find the zero point 0.5, the overall midpoint of price, you have equilibrium. So what this means is this price here, zero point 0.5, that's typically the price sellers and buyers tend to agree on, so price can normally stabilize. Also thinking about it like this, let's say you're a multi-billionaire. Let's say you're trying to get in for your puts here, but you're already looking at market, and well, market's already so low. Why would you want to get in your puts here? Why not let price push it to an equilibrium point where you know that all these buyers are already trying to push price to? Now, obviously, retail expectation is that they're going to break even higher, but this is exactly where banks, which I've already taught you guys how to look at, this is exactly where banks are going to want to bring price to make that huge dump. This is exactly what happens. Now let me show you guys in real life examples where this is happening and how you're able to spot it. Now, how can we use it in real life examples? Remember, equilibrium is more like a magnet to price. It basically insinuates that price most of the time when we come back, we are going to come back to that point. So one thing that I've learned over the time of basically using equilibrium multiple times is that it's not always just going to come back to your zero point 0.5. There's a reason why I've kept a zero point 0.6 here is because this general area, this overall zone is what I like to call my equilibrium kill zone, EQ kill zone, because EQ is short for equilibrium and kill zone because inside this rectangle is where most of the time we're going to find these reverses, we're going to find pullback, we're going to find points in time that price is starting to reject from this level. Sure, it might not give us the ultimate pullback, but it's showing us that hey, this level is showing fighting back, it's showing power, and we might get a reversal later on. You're able to use the equilibrium multiple ways in my opinion. I like to bring the zero point 0.6 above and below us at times just on how you're looking at price action. So same thing here. If we were to mark out our rectangle, we can see that where price is going to come back down to is exactly inside of our kill zone. But we're not just going to use our equilibrium kill zone as the final point of confluence. We have to make sure that everything aligns before we decide to go, okay, well, we're entering our equilibrium kill zone, time to get into the reversing play. Absolutely not. First of all, you have to make sure that this equilibrium is an actual conjunction to what's happening. So what's overall happening? First of all, we're on an uptrend. So we should only be looking for calls. Simple as that. Okay, perfect. We're seeing here a nice call setup. Okay, what's a second confluence that we have? Okay, we have overall EMAs right here. Perfect. What is a third confluence that we might be able to acquire starting this Tuesday day? Okay, what do we know about flat numbers? 450 is a perfect GX level or key level that price is going to want to be swept into. So we have a perfect 450 number here. We have EMAs, the 200-day EMA on a 5-minute time frame. I think this is a perfect play. We're seeing this retracement. We're seeing us get pulled back. And then how can we actually take this trade? First of all, once we get that pullback, we let market do its thing and we wait until it starts to finally pull away and we're able to get in once we can show that bullish structure. This is Microsoft on a 3-minute time frame. It is exactly where you could have seen we formed an inverse fair value gap alongside with this one. This is exactly where you would enter off the rejection of these EMAs, and there you go. Simple as that. Now, granted, this is on Microsoft. If you were trading NQES or even S&P 500, there's a large possibility somewhere around here you would have found an SMT as well. And from there, you simply just don't need much more. SMT, sweep of that sell side liquidity. Then we obviously have that reversing trade. You would chase it to the previous buy side liquidity, but you would see that, hey, we're breaking through with a fair value gap, so this is where you would be allowed to hold for even more. Let me show you guys one more example, but this one we're going to do it on NQ to see if we can find multiple things that we're looking for to make sure we're taking the best trades possible. Let's do a different example actually. Let's bring price in where we have our gone box and our EQ. So let me explain to you guys how you could also see if we are going to reverse or if we're not going to reverse. Previously, before we even get to EQ, what are you guys seeing? We're seeing a lot of bearish pullback. We're seeing a lot of bears slowly dragging the market down. And right before we end up crossing to the EQ and lower than EMAs, we end up breaking lower with a bearish fair value gap. Everyone knows that if we're trying to catch reversing trades, the last thing that we need is a fair value gap in conjunction to 200-day EMA. So starting to see this should be a red flag. You should not be wanting to take a reversing trade when you're starting to see things like this. Okay, let's see what ends up happening when we do get to this overall EQ kill zone though. Yes, we do start accumulating orders, and a lot of people could see as just an accumulation phase, this maybe being the manipulation, and then we would drag further up. Now, yes, as much as I would want to agree with that, the last thing that you want to see when we come to EQ's kill zone is, how long is this? What, almost an hour of just pure consolidation. If we would at least get this, where a pullback here, jump this, maybe break above, but overall staying within this level, that's something different. That is market still moving around its orders. This is just simply holding onto orders and then just letting the overall sell off of price do its thing and just slowly dragging even lower until we eventually reach this level where price did not sweep. Remember that. Price did not sweep this price point from Monday, January 6, 7:17 a.m. to 1 p.m. Now let's go check ES and see if that's what happened as well. If we go check on ES, we're actually able to see that, okay, let's line it up everything, 7:16 and 1 p.m. 1 p.m. is down here. That is a sweep of market, but we didn't get that sweep on NQ. What does that confirm? That confirms our SMT. From there, that's when we could be expecting a reversing move. So we could head back to NQ, look at market structure, and see what it's going to give us for a reversing trade. Okay, perfect. What are we getting here? Okay, we're getting reversing bullish structure. We have this as our previous low, so we're going to want to show that we can break above this. What ends up happening to this fair value gap? It ends up getting inversed with this one. So now this one is an inverse fair value gap as well. So what's everything that we have? We have SMT, we have the break of structure, we have an inverse fair value gap, we're starting to get above the EMAs. Perfect. The second you see that pullback and the second you see us starting to pull away, you could just enter your trade and hold it. Now, if you were trading futures, you would simply just hold it. You would respect your stop loss, you would respect where you have it at, and you would simply just hold the trade. Now, where would you chase this trade to? This trade could move around a lot. We can already see it. It's really rejecting. That's why I always look at this 200-day EMA. So what's something that we can pull out that might help us find out where we can look to be? We bring in our equilibrium and we look towards where price could eventually be looking to stop us out. So perfect. Now that we have our marked out level, We have our marked out liquidity zone to say. We also have to look at multiple different things. We can also have this fair value gap up here be a nice order, and that's when you start dragging these things out and you start looking at other confluences and you're like, okay, this is exactly what could pull market back down. So as long as I have them marked down, as long as I target these levels to scale out, I'll be fine. And you would have been. Market would have closed on you right around. Oh, what's in this futures? It would have closed all the way over here, I guess. So you would have just been able to hold it. But there you go. That is how you can use equilibrium in confluence of taking your trades. You have to be able to make sure that you're stacking your confluences. Simple as this. You need to make sure that when you're taking a trade, we have swept a form of liquidity. We are also, once we've swept it, shown consolidation slash doji candles, making sure that we're not dumping even lower, making sure that we have EMAs on our side, and then potentially looking for SMT, marking out equilibrium, making sure that we have all these things, and then important fair value gaps, because there are a lot of fair value gaps that in reality aren't really that important. Make sure that you're marking out all of these things, making sure that you're looking at all of these things. And I promise you guys, trading is going to become at least a little bit easier. I hope you learned something. I hope I wasn't just yapping away. I hope you guys have an amazing day, and I'll see you guys tomorrow.